Thank you, Pat, and thank you indeed for coming over to Dublin to speak to the team here. What I want to talk to you about, as Michael says, I spend my time gallivanting. I get to go on exciting 18-hour flights to boring places, but Michael considers it gallivanting. But I do travel to quite a number of parts of Milliman and indeed engage with our offices right around the world. And what I wanted to give you is a flavour for some of the things that they are talking about in those countries, and just in terms of them, what they might mean here. So get some common themes I'm seeing across our client base globally and give you some sense for what that means here. So the agenda, I'm going to cover just a few bits. I'll start off with technology, just kind of catching up on a few of the themes that Pat has given to you. And then I'll move on to some of the implications of, because these are the things I hear people talk about a lot: technology, low interest rates, growth and where we're going to get it, and regulation. And obviously, depending on who you're talking to within an organization, they'll have different order of priority, but they're the sorts of things people are talking about all of the time. So I'll talk a little about technology first, just to kick off. So what are the trends that we're seeing? Well, the first thing for me, it's just 35 years next week, I think, since I joined the insurance industry. And for probably 30 of those years, as far as I could see anyway, and admittedly being somewhat biased from being life, non-life was boring. It was pretty much the same 5 years ago as it was 30 years earlier. It was very much an unexciting area, whereas all the really exciting developments in insurance are happening in life. Well, bad news life, people, it's flipped over in the last 5 years, and non-life is where it's at. So if you go to conferences on InsurTech, you go to any of the technology conferences, the really exciting things are happening in non-life. And I'm going to talk about a few of those on the next slide as well. But we're beginning to see a little bit of things happening on life, and there's beginning to be a focus of, the customers are changing the way they want to do things. They're seeing different experiences in the non-life space, but indeed right across their digital world and the way they interact with businesses. And life companies are starting to look at some of those, and I look at a little bit of those too. So starting off with the non-life piece. Telematics has been something that's been around for a few years, but it's been slow to get going, but it's really beginning now, I think, to take a little bit of interest. So telematics, for anybody who's not familiar, where you have something in the car which tells you how you're driving, what you're doing, what's happening at any given point, and then allows you to analyze that. And initially was designed, I suppose, for insurance to give lower premiums to the good risks and penalize you if you weren't driving appropriately. What we're finding now is quite a change in that, and I posted a very interesting article to LinkedIn for everybody who reads it, from somebody in the US who does some work on this, and where we kind of helped them a little bit on their telematics analysis. But you're beginning to see telematics being used very much as a safety tool to understand what's actually happening and how we should change things and how we should change behaviors. So, when you've got something like, and one of the interesting things in that article was, when you have your telematics built on a phone, it's on your mobile phone, instead of being just something built into the car, you got one extra layer of information, which was the interaction with the phone, and to what extent did interaction with the phone lead to additional accidents. And it actually hugely exploded the range of from good to bad driving behaviors. So you could see what was causing the distractions, and more as they're beginning to understand and have kind of the Internet of Things essentially, and giving you information. That sort of data and the ability to analyze it is giving us much more information. So hopefully better driving, safer driving, and ultimately easier for insurance companies to price risk. But ultimately, what a lot of instant approval is probably the biggest piece. What we're seeing now is essentially the non-life space, particularly on the retail side, completely changing. So over time, what we consider an insurance, who said a car insurance should be something you buy today to have for a year? And what's beginning to happen is the technology is allowing insurers, and we're seeing new people come into this space to look at, well, actually what I want to do is I want to be paying much more related to how I drive, when I drive, if I drive, and almost that I'm just paying, only when I switch on the car do I start paying. And the insurance company knows instantly what you're doing, what sort of roads you're on, whether you're in Ireland, whether you're on holidays in France, and we better really rate you because you're almost certain to crash. So you've got a whole bunch of that going on, built in then with analytics. Analytics not just on the retail side, but we've seen a lot of weather events in the last couple of weeks in the Caribbean and in the US. the analytics about what's causing them, what leads to bad events, really terrible events, where the exposed areas and so on are. But similarly, in the motor and other related areas, enormous amount of analytics giving much more information. And I talked a little about changing definitions. So we're finding that there's quite an enormous amount of rethinking, and Pat talked about culture and rethinking the model. And in non-life, I think particularly on the retail side, over the next 10 years, we'll see an enormous change to all of that. So you get things like, cover on demand, autonomous vehicles I often talked about, but again, that's completely changing the motor market. Who's the insured, what is the insured, who's responsible? Is it a failure of the product if you crash, or is it a failure of the driver, for example, if there's such thing as a driver? But you've got issues like identity theft, gadget insurance, and of course cyber. I mean, the other piece, cyber risk, is the big piece that is out there, and you can't talk about all of the Internet of Things and everything else without talking about cyber risk. And again, for non-life, that's actually opened up a whole new market. So now we've actually got a whole different market to ensure cyber risk. And of course, protecting against it is becoming a huge industry in itself. So life insurance is trying to catch up. And the things that I'm seeing happening around the world as I talk to clients and I talk to some of my colleagues, on the analytics side, and again, some of this is just about how to do things better, how to target things better, propensity to lapse, propensity to buy, applications. You're getting some analytics about group purchases, so you're saying, well, actually, we might not be able to do analytics at the individual, but we can do analytics at the group, so we know that for employees of Google or employees of Irish Life or of Aviva or somebody, we can come up with a different measure. But the more important thing is things like instant approval and so on. So if people are looking at the way that products are bought and how they're bought, you're beginning to see greater work being done about how can we approve people for cover instantly. See some very interesting things just in the bottom one there on drug analysis, or by that I mean what drugs people are using. So one of the pieces of health information you can actually get electronically is what prescriptions do have people taken. So in the US particularly, there's a very good piece of information where people give authorization when you want to apply for insurance. You can have access to my pharmacy records. Build a lot of AI and the sort of facilities that Pat was talking about behind all of that, and now you can use that information to get a sense for whether they're likely to be healthy or not, and that allows you to skip the underwriting process and to issue a policy straight through. So you get clever pieces like that, but you're also seeing people moving to facial scans and lots of other interesting things, and analyzing the social media, and we will see some pieces here, but the point is not the technology. The point is, what can we actually do differently with it? I think an interesting piece that we're seeing some work on is on longevity and long-term care. So, there is a focus. The industry knows that that this is an area that, the population is aging. We hear about population aging here all the time, and a lot of that is around the over 65s, but you look at the over 80s, the over 85s, there's actually an explosion in the population at those age groups. And really, there are no products that properly deal with long-term care, or very, very few. And in each of the markets, we're seeing people saying, can we do some things, and we be clever in technology and design some solutions for that particular space. And the other piece then is genetics and diagnostics. So some of this in the medical space, and then it's how the insurers pick up on it. But there is enormous work happening in the medical space in genetics and diagnostics, which could mean that we all live forever, or that we all have ways of living much longer than we do at the moment. And that's going to, in some sense, have impacts for insurance, whether it means there's a reduced risk for life insurance. But to me, all of the trends in the last 70 years, and particularly in the last 5 or 10, are saying there's actually going to be less need for life insurance over time, and more need for, end-of-life solutions, longevity and long-term care. So that's where a lot of the effort is being placed. So lessons for Ireland in terms of technology. I think one of the interesting, what we see is venture capital. Venture capital is out there from all of the big groups. They're going out and buying. So they're saying, we want to play around, we want to test all of this out. we're not sure who's going to win, but we're going to make sure to have some investments in some players so that if some of them win, we'll be in there. And you see all of the big insurance groups doing that, and if your group isn't, you should be asking why. The second area is building. So, and to some extent, this kind of is what Pat was talking about. She was talking about transformations of technology and culture being important. So sometimes they're saying, well, we're not sure we can change that culture here in the middle of our big organization. So they create a garage or a sandbox or whatever your preferred terminology is, and they put a whole bunch of people in a warehouse somewhere and say, off you go, play around with the technologies, come up with new things. So it's a bit like internal venture capital rather than go and buying something new. So get the culture to do that. And of course, the other alternative is to, stick with the old way and hope. Moving on to low interest rates. I mean, we all know what the low interest rates, and in the slides here I just put two interest rates. The one on the bottom is the ECB rate, and the one on the top is the German 10-year bond rate. And I just go back to 2008, I think it is on the slide. So, over that 10-year period, obviously both falling very, very rapidly. And that's put enormous strain on balance sheets. And in some senses in Ireland, we don't see that as much because we're very unit-linked focused. But in other countries where you have more traditional products, this is seen has enormous impact. Guarantees are almost impossible to give. The existing guarantees have generally beginning to cause problems because typically liabilities were longer than assets. Accounting systems didn't necessarily deal with this terribly well, so there wasn't an incentive to properly match. So we're seeing volatility, increases in capital, and basically people saying, well, is there something else I can do because I can't continue doing these products? And some of the things we can do are being, you start saying, what can I do? Well, one, I can cut costs. Secondly, I'll increase spread risk. So instead of investing in government bonds, 10-year German bonds, for example, I'll go into corporate bonds or other things. And actually in the Eurozone, the spreads on corporates are very, very low, much lower than they are in sterling and in dollars. So I say when Ireland was a basket case and our bonds were yielding an awful lot of money, we were actually a really attractive place for the German insurers to come because they really needed yield and they needed to get it wherever they could get it. And if we were yielding 300 basis points more than Germany, didn't matter how big a basket case were, they needed yield, so they came and bought our bonds. When our bonds fell, they actually sold them all because they had no interest in low yielding bonds. So this is I just picked Allianz as a sample company here, but I could have picked any of the big global insurers and sort of disclosures they're doing. So for them, it's about showing the disclosures and saying, hey, look at us guys, we're being good, we're selling far fewer guaranteed savings and annuities, which is the top line with the -7%. And we're being much better at protection and health and unit-linked without guarantees and capital efficient. Now in this particular example, the capital efficient was down. But all of those groups are in their life and health divisions saying, we're going to prove that we are better at this piece than we used to be. So that's their big focus, and it's all of the groups. So what do you do what are the lessons for Ireland? Well, first of all, the insurers, they don't want to invest the capital required for guarantees. They can't sell savings in low interest rate environments, so the focus is on protection. And it's not life and critical illness and disability but also longevity and long-term care. Innovative solutions, basically continue to look for innovative solutions. That's where the money's going to be. And you won't get large groups to invest and give you money to invest in high capital savings products. They're just not interested. This is a slide from Swiss Re of global insurance premiums since 2005. Now I say almost flat, I mean it's not quite flat, but the bottom line is premiums in non-life, the middle line is life, and then the top line is the combined. But you can see a fairly flat position across the globe over the last number of years. And we know we've been through the crisis and everything else. So what I did was I actually broke that down by continent. So just to show you kind of how things are going at a continental level. So Europe is the green line, which started 10 years ago as the most significant. North America is the gray line that's kind of running around the middle. Asia is the blue line, which is rising. And then you have Africa and Latin America down at the bottom. So you can see that the growth has all come from Asia, really, that Europe and North America have been pretty flat. There's been some growth, and the scale here doesn't really show it, but there's been growth, obviously, in Africa and Latin America as well. A little bit of, so what? But, if you look at the outlook for these continents, then you say, well, where are they going next? So look at Europe. It's got slow growth, political instability. We all know, I think there's yet another Brexit paper being published this morning, but has had ongoing political instability of various forms for 10 years. Very difficult to generate attractive products because of the low interest rate environment and everything goes with it. You've got an aging population, therefore very much a shift towards longevity products, trying to move to capital efficient, and basically saying we have to use technology to find better ways to do business, that this is not going to be about a rapidly growing top line, so therefore we have to find other ways of doing business in Europe. Similarly, in North America, it's very similar. I mean, you've got the baby boom generation. I mean, actually the population is not as old as Europe, but you have a very large group who are quite asset rich coming towards retirement, so there are huge opportunities there in the at and near retirement space, so you get a lot of focus there, but probably more focus on long-term care happening in the US than we're seeing in Europe. But for most groups, Asia is the engine of growth. I mean, it's by far, in a way, population-wise, the biggest. We've got rising incomes, growing middle classes. Again, sometimes opportunities that allow you to do things completely differently. So coming in with a completely different model is easy, but also we have some people still using traditional models. But we're seeing a lot of new insurers who come completely new to the market, targeting particularly countries like Hong Kong and Singapore and even China, who are quite technology savvy and haven't got those old systems. So enormous amount of capital being invested in Asia. And actually in surprising interest in Africa and Latin America as well. So I think a lot of insurers are looking at Africa and Latin America as being where Asia was 20 years ago. So again, enormous populations. For all we read, and inevitably there are horrendous problems, particularly in Africa and various parts of the continent. It is a considerably more affluent continent now than it was 20 years ago. The levels of poverty have reduced, the numbers of middle class are rapidly increasing, and you're seeing a lot of interest in countries like Nigeria, Ghana, Kenya, and South Africa has always had a developed market. So what are the lessons for Ireland? Well, the first thing is, the bad news is, if you're a big insurance group and you're deciding where to put your capital, you'll very rarely read that we're going to throw all our money at Europe because we think it's a great place to invest our money. What they're saying is Europe will be a nice, calm, slowly growing, and we'll make our money by diversifying into Asia or into other places. So, going back to some of the things what Pat was saying, when you're in an insurance market, in a mature market, it becomes about expense control, it becomes about consolidation, so we're seeing M&A activity, and you've seen a number of consolidators enter the Irish market, and Phoenix that Pat talked about was essentially an example of that in the UK. People looking to reduce cost of distribution, and auto-enrollment and mandatory pensions can be a way here, but we're going to see a need to actually have very, very efficient operations in Europe if people are going to invest. But I think there's a huge opportunity here in the longevity and long-term care. Interesting, the Pensions Authority, maybe a month or so ago now, came out with their annual report and kind of where things were in the pensions business. And what struck me was there were 34 billion in assets just for retirees, not even for people close to retirement. For actual people who are post-retirement, in retirement, receiving pensions, there's 34 billion. And pension funds are generally looking to de-risk. So if I were an insurer in Ireland, as we've seen in other countries, I would have my eyes on the 34 billion. And the good news is that generally pension funds are improving and being in better shape and in better position to actually do something with that. So regulation is the last area I wanted to talk about. I just wanted to talk to you a little bit about some of the global themes we're seeing, because actually they're very much the same things that you're seeing here in Ireland, and they're coming from sometimes global space. So I'm going to talk about a few things and then move on to just briefly to IFRS. So the first thing I just wanted to kind of share with you, because people aren't necessarily familiar with a body called the International Association of Insurance Supervisors. And it's essentially the club that all the regulators are members of. So the Central Bank in Ireland, the PRA in the UK, ACPR. So apart from being part of AOPA, they're also part of a big global group, which is the International Association of Insurance Supervisors. And they have come up with some insurance core principles. And I just give some examples here. There are 26 of them, and I don't intend, you'll be glad to know, to go through them all and read them out to you. There's about a 350-page document you can access on the web. But what I wanted to say to you is that the themes that you're seeing coming up here in Ireland are exactly the same themes you're seeing coming up in every other country, because a lot of them are coming from these insurance core principles. And the most recent update of these was in November 2015, so not very long ago. So for example, we've spent a lot of time talking about Solvency II. When I talk to my colleagues in Korea, they're talking about Solvency II, which is actually coming in the same time as IFRS in Korea. Same in South Africa, they're talking about Solvency II now in the South African market. Or we're talking about Solvency II in various countries in South America. So the same drivers are there. So it's worth your while keeping an eye on what's happening at the IAIS if you want to know what's going to be coming down the track in Ireland. And a few of the themes that we're seeing, conduct, ICP 19 is on conduct, and there are a few other related ones. But the issues that you're seeing in Ireland, PRIPS, Product Oversight and Governance, Insurance Distribution Directive, CPRA, some consultations CBI are doing on commission. All of those are in there, and we're seeing common themes. So when I talk to our colleagues in other countries, they're dealing with some of the same issues. One of the biggest issues that was out there for Milliman in the US last year and early this year was something called the DOL rule, which Pat will be familiar with, which is the Department of Labour, which has responsibility over a lot of the pension things, and they were talking about the fiduciary responsibility of distributors, which basically came down to how much they had to know their customer and how much they had to act in the customer's best interest and all of that good space. And the good news for the insurance industry to some extent was Obama was a fan of this new rule. Trump wasn't. He doesn't like regulation, but actually it caused a little bit of chaos because he couldn't decide whether to change it or not. The second area I have here is just regulatory capital, and I don't expect you to be able to read that graph that's in there. You might be able to see it on your piece, but actually it's from ICP 17, but actually looks very like what you'll see with a Solvency II balance sheet. And on the right-hand side here is just a time frame. There's something called international capital standards, which only apply to internationally active insurance groups, but actually that ends up being an enormous part of the industry. And there's a bunch of new rules coming in actually in 2019. So rapidly coming down the track, you've got Solvency II cracked, you're beginning to panic about IFRS, you possibly haven't even thought about international capital standards, and it's going to be an issue, and it's going to be different from either of the other two. It's closer to Solvency II. And then, of course, we've got IFRS 17 and IFRS 9. I don't intend to go into the timetable. You're all probably familiar enough that January 21 is the date. So what we're seeing and what I see at the moment is almost every day, somewhere in Milliman, we're getting an RFP on somebody saying, how do I actually make sure to deliver on this? And that might be talking to Pat about some of the tools she has, or just generally helping out and helping people understand it. And for people who are interested and want to get into the bones of that, we are having a seminar in October specifically on IFRS 17. So we're not going to send it out to everybody because probably about 50% of the population here would be bored to death if you came along to it. But if we don't send it to you and you are interested, come back and ask us about it. So some lessons of Ireland. The global system is now connected. There's a lot going on. There is a pace of change, and some of that is coming from the insurance core principles. It's going to continue to change. We're going to have increased and more complex reporting, shortening timetables, increased disclosures. So what I would say to you is, in all of that world where you've got a world that says low cost, you've got all of these other pieces going on about increased disclosure, about increased reporting. You really need to then look at industrializing or automating or finding other ways of doing your work. We've probably come to about close to the end of my time, so that's just really a wrap-up slide, but it says everything I probably said already. So, Michael, back to you.